Hello and welcome to the Financial Management module on financial planning. This module is part of a series of e-learning modules designed to foster and develop the financial management skills of people working in global health. Each module will offer an opportunity to learn from experienced managers and to engage in learning activities that are designed to apply the skills and concepts to your own professional setting. This e-learning module was produced by the University of Washington Department of Global Health, based on content from the Financial Management Essentials Handbook developed by Mango. Mango is an award-winning UK charity whose mission is to strengthen the financial management and accountability of non-governmental organizations around the world by providing innovative, high-quality in-person trainings, consultancy and recruitment services. This module provides an overview of the basic content, but not the full experience of attending one of Mango's practical and participatory training courses, where the motto is taking the fear out of finance. A library of Mango's own publications, as well as information about their services and their open training program, can be found at the Mango website. We encourage you to visit this resource of information on financial management and accountability. When you have completed this lesson, you will be able to explain the planning process and how it links with financial management. Understand the different types of budgets and when to use them. Describe different approaches to budgeting and how to use a budget worksheet. Apply good practices in budgeting and use financial planning as a tool for managing multiple donor projects. What is financial planning, and how does it link with financial management? Financial planning is both a strategic and operational process linked to the achievement of objectives. It involves building both longer-term funding strategies and shorter-term budgets and forecasts. It is the heart of effective financial management. Financial planning does not start with budgets and numbers. It starts with a clear idea about what it is you want to do and how you intend to do it. So in order to produce effective budgets, you must have good plans to base them on. Now that you have a better idea of what financial planning is, click the forward button to learn about developing a strategic plan. Organizations exist to achieve certain objectives. A strategic plan explains how the objectives are going to be achieved. A strategic planning document has several parts, stating with either or both a vision and mission, and then going into more detail about how the mission is to be achieved. This concept can be illustrated using a planning pyramid. As the level of detail increases, participation of staff members in the planning process should increase. The vision represents the very long-term goal of the organization. It is the big problem which the organization alone cannot solve but strives towards. Most organizations have a mission statement as part of their founding documents. It clarifies the purpose and values of the organization in a few general sentences. Objectives are the building blocks which help an organization achieve its mission. Objectives or goals give focus to the organization's work and state in clear terms what it is that the organization hopes to achieve over a given time frame. Strategies set out how the organization will achieve each of its core objectives. They outline the actions which will be taken for each objective. A strategy may be subdivided into several more specific and detailed plans for each activity, function, or project. Activity plans have a shorter time focus, about 1 year, than strategies and objectives, and activity plans are subject to ongoing regular review as progress is made. Activity plans are the basis for budgets, so they must be very SMART, specific, measurable, achievable, relevant or realistic, and time-bound. Once plans are set, the organization draws up its budgets and cash flow forecast to help implement the plans. During the year, financial reports are produced to compare the budget with actual performance. This review stage is very important to the financial planning process since it will highlight areas where the plans did not happen as expected. This learning process will help to identify revisions which need to be made to the plans. And so the cycle continues: plan, do, review. Now let's talk about what a budget is. A budget describes the amount of money that an organization plans to raise and spend for a set purpose over a given period of time. A budget has several different functions and is important at every stage of a project. A budget is necessary for planning a new project so that managers can build up an accurate idea of the project's cost. This allows them to determine if they have the money to complete the project and if they are making the best use of the funds they have available. The budget is a critical part of any negotiation with donors. The budget sets out in detail what the organization will do with a grant, including what the money will be spent on and what results will be achieved. An accurate budget is needed to control the project once it has been started. The most important tool for ongoing monitoring is comparing the actual costs against the budgeted costs. Without an accurate budget, this is impossible. Because plans sometimes change, it may be necessary to review the budget after a project has started. The budget is used as a tool for monitoring and evaluating the efficient financial management of the project. Who needs budgets? Budgets are used by different people for different purposes. The board of directors or principal investigators need the organization's overall budget because they have to formally approve it and monitor its progress. Chief executives and project directors need budgets to keep an eye on progress of the whole organization and the funding situation. Project managers need budgets to oversee the implementation of their project activities. Sponsors or donors need budgets to accompany funding applications and to see how an organization intends to spend its grants. Finance staff needs budgets to make sure there are enough funds in the bank to cover anticipated expenditure. Now that you have learned what a budget is and who needs budgets, click the forward arrow to learn about the different types of budgets. Essentially, there are three main types of budget: income and expenditure budget, the capital budget, and the cash flow forecast. Click on each tab to learn more about each type of budget. The income and expenditure budget sets out the anticipated running costs, also referred to as recurrent costs of the organization, and shows where the funds will come from to cover the costs. The annual income and expenditure budget can be broken down into shorter periods or phases, quarterly or monthly, to assist with monitoring progress. Click on the image below to view an example of an income and expenditure budget. The capital budget lists the expenditure you intend to make for the coming years on capital projects and one-off items of equipment that will form part of the organization's fixed assets. Equipment means an article of non-expendable, tangible personal property, having a useful life of more than 1 year, and an acquisition cost which equals or exceeds the lesser of the capitalization level established by the non-profit organization for financial statement purposes, or $5,000. As these usually involve major expenditure and non-recurrent costs, it is better to list and monitor them separately. Examples of capital expenditure include vehicles, office furniture and equipment, computer equipment, building construction, major renovation works. The implications for the income and expenditure budget should be noted, such as running costs for vehicles. A separate capital budget is not required if only 1 or 2 capital items are to be purchased. In this case, it is sufficient to incorporate the capital items in a separate section of the income and expenditure budget. This is most common in a project budget. For good cash and financial management, cash reserves are essential, as there will always be times when grants are delayed or unexpected expenses occur. The cash flow forecast or cash budget helps managers identify those times when cash levels become critical. It predicts the flow of cash in and out of the organization throughout the year by breaking down the master or overall budget into smaller time periods, usually 1 month. Whereas the income and expenditure budget shows whether the organization is covering its costs over the whole year, the cash flow forecast shows whether it has sufficient cash in the bank to meet all of its obligations needs as they arise. The cash flow forecast helps to identify likely cash shortages and allows avoiding action to be taken, such as requesting donor grants early, delaying payment of certain invoices, or delaying some activities. Care should be taken if you follow these strategies, as there are likely to be negative consequences. For example, delaying payments could affect your relationship with suppliers, and delaying activities will affect the communities you work with and your ability to implement the program as agreed with your donor. When you are ready, click the Next Screen button to continue. Cash flow is the lifeblood of any business, and therefore it is important to devise a system to track incoming and outgoing payments. Having that system in place will alert you to any issues before they become serious problems. To prepare a cash flow forecast, you will need all of the organization's activity plans and budgets for the year. This exercise is best completed using a computer spreadsheet such as Excel. For each item of income and expenditure on the budget, you will need to predict and plot on the forecast sheet when cash will come in and go out. This is dependent on when activities are planned to take place. Some activity is more predictable than others. For example, monthly activity such as salaries or annual activity such as insurance and audit fees. Other transactions are unpredictable, like repairs. Once the budget has been broken down into each month based on the activity plans, it is possible to calculate the net cash flow to determine whether there is more cash coming in or going out, or vice versa. It is also important to include an estimate of any bank balances held as reserves, as this will help manage our cash flow. It is essential to forecast what is going to happen to make sure funds are in the bank to pay for project activities. If there are insufficient funds in the bank to pay for project activities, delays will follow and donors can get upset if the program deliveries are unmet, so it is very important to develop a cash flow forecast system. Now let's discuss a few tips on preparing a cash flow forecast. Let's discuss a few tips on preparing a cash flow forecast. Cash flow forecasts are not simply the budget broken down into 12 equal installments. You need to know when specific activities will take place. For example, in a training project, when will the courses take place? When will costs have to be paid? And will the course fees be paid in advance? Expenses must be entered on the cash flow forecast when the cash is expected to leave the bank. So an invoice for January's electricity will probably be received in February and paid in March. Some payments are paid monthly, such as salaries, but don't forget that deductions, such as income tax, are often paid to the authorities the month after salaries are paid, or in some cases paid annually. You need to take into account payment terms and income schedules. For example, auditors might require a 50% deposit of the audit fee before the audit, and the rest follows after the report is filed. So although this is an annual activity, the actual cash movement is affected by payment terms. Similarly, grant schedules dictate the inflow of cash from donors and sponsors. For unpredictable expenses such as equipment repairs, it is recommended to prepare a projected monthly or quarterly expense. And finally, although obvious but easily forgotten, you will want to exclude non-cash transactions from the cash flow forecast. For example, donations in kind or depreciation. So if these are on the budget, they have to be left off the cash flow. To facilitate planning and to enable control to be effective, many organizations try to ensure that the overall structures of their budgets correspond closely to the organization structure. It is possible to organize budgets at different levels, for example, by department, program, or project. For this example, we will use Milestone's budget hierarchy. Note that this reflects the cost center structure that we looked at in the previous module. The lower-level project budgets are consolidated into the departmental budget. Departmental budgets are in turn consolidated into one master budget. This structure allows budgets to be delegated and monitored at the project level, while maintaining an overview at department and association level. We have now discussed the planning process, different types of budgets, and when to use them. Now let's take a look at the different approaches to building a budget to determine the approach which works best for you, given the skills and time available. There are two main ways to build a budget: incremental and zero-based budgeting. There is also activity-based budgeting, a form of zero-based budgeting. Incremental budgeting bases any year's budget on the previous year's actual or sometimes budgeted figures with an allowance for inflation and known changes in activity levels. It has the advantage of being fairly simple and quick to implement. It is most useful for organizations where activity and resource levels change little from year to year. A frequent criticism of this approach is that it does not encourage fresh thinking and may perpetuate existing inefficiencies. It also makes it difficult to justify the figures to donors, since the original calculations may be long forgotten. An alternative approach is to start with a clean sheet, a zero base. Zero-based budgeting ignores previous experience and starts with next year's targets and activities. Zero-based budgeting requires the writer of the budget to justify all the resource requirements. This process may suit organizations going through a period of rapid change and those, like organizations, whose income is activity-based. Zero-based budgets are said to be more accurate since they are based on the detail of planned activities. However, the approach does impose a much greater workload on managers than incremental budgeting. A special form of zero-based budgeting called activity-based budgeting is frequently used in the organization sector to create project budgets and is preferred by many donors. Top-down and bottom-up budgeting methods are both techniques for allocating and reporting budget amounts. Top-down budgets are imposed by senior managers. Bottom-up budgeting is where operations staff is involved in setting their budgets. With bottom-up, you could define budget organizations for the lowest level within your company, such as by cost center. Then, after each manager enters their cost center budget, you can summarize these budgets at the division and company level. With top-down, you enter budget amounts to key accounts at the top level, then distribute those amounts among lower-level accounts. For example, you can enter a budget for the entire company based on goals established by top management, then assign budget amounts to each division or cost center. Many organizations employ a mix of top-down and bottom-up approaches. You can use a combination of these methods by choosing the method that is most appropriate for each part of your organization. The process of preparing a meaningful and useful budget is best undertaken as an organized and structured group exercise. The budget process involves asking a number of questions. What are the objectives of the project? What activities will be involved in achieving these objectives? What resources will be needed to perform these activities? What will these resources cost? Where will the funds come from? Is the result realistic? Once the budget has been agreed and the activity implemented, the process is completed by comparing the planned budget with the actual outcome to determine any variances and if there is anything we have learned or could do differently next time. Now that we have covered the process of building a budget, let's discuss the best practices in budgeting. Since many different people will need to use the budget for different purposes, they should be able to understand it and adapt it when necessary without any additional explanation beyond what is written down. Clarity and accuracy are essential, so it is important to keep notes on budgeting assumptions and how calculations have been made. There are several stages involved in constructing a budget before it can be submitted for approval to the management, so it is a good idea to prepare a budgeting timetable and commence the process early. This could be up to 6 months before the start of the financial year, depending on the size of the organization and what approach has been adopted. When setting a budget for the first time or when reviewing a budget, it is important to pay attention to the chart of accounts. This is because the budget line items also appear in accounting records and on management reports. If the budget items and accounting records are not consistent, then it will be very difficult to produce monitoring reports once the project implementation stage is reached. One way of achieving consistency is to design a budget preparation sheet for your organization, which will act as a memory jogger and prompt staff to include all relevant costs. It will list all of the main types of income and expenditure that a project or department might have in a typical year. It is important to be able to justify calculations when estimating costs. Even if you use the incremental method of budgeting, do not be tempted to simply take last year's budget and add a percentage amount on top for inflation. While last year's budget could be very helpful as a starting point, it could also be very misleading and contain historical inaccuracies. One of the best approaches is to make a list of all the inputs required and specify the number and unit cost of each item. From this detailed worksheet, it is then a simple matter to produce a summarized budget for each line item and is very easy to update if units or costs change. This illustration provides an example of the budget worksheet format. Try to avoid the practice of adding a bottom line percentage for so-called contingencies on the overall budget. As a rule, donors do not like to see this, and it is not a very accurate way of calculating a budget. It is better to calculate and include a contingency amount for relevant items in the budget, such as salaries, insurance, and fuel. Irrelevant items would include computers and furniture for which costs are not subject to unexpected increases. Every item in your budget must be justifiable. Adding a percentage on the bottom is difficult to justify and difficult to monitor. There is a tendency in the organization to underestimate the true costs of running a project for fear of not getting the project funded. Here are some of the most often overlooked costs. Staff-related costs, for example, recruitment costs, training, benefits, and taxes. Startup program costs, such as publicity and legal costs. Overhead or core costs, for example, insurance and utilities. Vehicle running costs, equipment maintenance and repairs for items such as photocopiers, generators, and computers. Governance costs, such as board meetings and audit fees. This table shows a typical layout for a budget worksheet as used in activity-based and zero-based budgeting. The table describes the inputs needed for a 4-day workshop for 20 participants with 2 tutors. The table details items required for the workshop, the quantity and the cost per unit. The final column provides the budget for each item. Click the forward arrow in the top right of your screen to learn more about each column. The code used in the organization's accounting records is useful if you are discussing the budget and need to draw attention to a particular line in the budget worksheet. An activity-based budget is usually separated into sections, each with a subtotal of costs. Each block will have a unique number, as in the above example where all workshop-related costs are listed. A short description of each line in the budget. Try to include different inputs on a line of their own rather than lump similar costs all together. The unit type is the basis for the costing and calculations. The unit type will vary according to the budget item. For example, under Object Code 0501, the budget for lunches is being costed on a per delegate basis. This specifies the number of units required for the project. For example, for Object Code 0501, we need lunches for 22 delegates, 20 trainees plus 2 facilitators. The quantity is useful where multiple items are required. For example, under Object Code 0501, we need to provide lunches for 22 delegates on 4 days as it is a 4-day course. In 0435, we need to provide accommodation for 2 tutors, whereas in 0391, we only need to hire 1 room. The unit cost lists what each unit costs as defined in column C, unit type. So for Object Code 0501, we see that it costs $5 for lunch and refreshments for each delegate. Total cost is calculated by multiplying the number of units by quantity by unit cost. So the cost of lunch and refreshments for 22 delegates on each of 4 days at $5 per delegate costs $440. 22 times 4 times 5. A column for notes or comments is useful to clarify what the item is for and how quantities have been arrived at. It is useful to add another column which details the donor code or line item reference, as this makes it easy to transfer the budget figures into the donor budget and reporting formats. Deciding on the unit type requires some careful thought, as it is not always so obvious and it does depend on how the items are usually sold or priced. So what makes a good budget? The sign of a good budget is that anyone could pick it up and use it to manage their activities. It must be suitable for the purpose, have the right level of detail for the user, be easy to read, have clear calculations, include all costs which are justified and accurate, and provide explanatory notes. It is important to have a clearly stated policy on how your organization will cover its core costs. These costs have to be funded if allowable by the donor, just like any other cost incurred in an organization. The starting point is to produce a separate budget for core costs so they do not get overlooked or ignored. There are essentially 2 ways, or a combination of both, to fund your core costs. Use unrestricted funds, for example, money given to the organization for general purposes to cover all or part of core costs, or charge core costs out to projects using a prearranged apportioning ratio. The methods which can be used to charge out core costs to projects will be covered in another module. When a program or project has more than one donor, it can present a number of financial planning problems. In particular, donors have different budget formats and layouts, which they require you to use when applying for funds. Budget line items and descriptions vary, so it is not clear exactly what each category includes or excludes. For example, transportation versus travel versus vehicle running costs. It is not always clear who is paying for what activity or item. Different donors have different policies on core costs. It is not always clear if all the core costs are covered. Sometimes double funding occurs for certain budget items while other items are underfunded. Let's now take a look at some solutions to the challenges we have discussed. Prepare a carefully designed and detailed chart of accounts. If the chart of accounts is detailed enough, it will be able to cope with different donor budget formats. For example, the category transportation in an organization's chart of accounts is extended to or subcategorized to fuel and lubricants, vehicle maintenance, vehicle insurance, public transport, air travel, distribution costs, etc. Use the budget worksheet approach to cost all projects. Because this approach provides a very detailed budget, it is possible to transfer the information to any other budget formats as required. The level of detail provides maximum flexibility. Include some indirect costs as a separate expense category if allowable in project budgets. Include a share of the indirect project costs, such as office rent or general office supplies, central management as a separate line item as a percentage of the total direct costs. There is usually a predetermined percentage that an organization is allowed to charge to the donor, excluding some items, such as fixed assets, over a certain predetermined value, for example $5,000. Take care, as all costs must be justifiable and allowable. Prepare a funding grid. A funding grid is a special table which provides an overview of which donor fund is paying for what part of a budget. It is an internal planning tool which should be updated regularly as new information becomes available. It is also useful for renegotiating funding agreements and identifying other funding needs. Let's discuss in more detail how the funding grid works. The overall project or program budget is detailed in column 1. Donor budgets are entered in the next columns and reconciled to the overall project or program budget. Unrestricted funds are then entered to plug the gaps. The final column identifies any double funding and remaining funding gaps. In this example, we can see that there are some predicted funding gaps for the admin and travel budget lines indicated by the negative figures in brackets. There is also a predicted surplus of funds on the training budget line of $2,800 indicated by the positive figure. And overall, Milestone appears to be $24,600 short of the funds it needs. However, Milestone must not assume that it can keep the extra $2,800 on the training line and use it elsewhere in the budget. These funds are restricted and presents a double funding situation. In this case, Milestone must contact the donor or donors and make a request to reallocate the surplus funds on the training line to other budget lines where there are funding gaps. If the donors refuse, the surplus restricted funds must be given back to the donor. To recap what we covered in today's lesson, you should now have a better understanding and awareness of the planning process and how it links with financial management. Today, you learned the different types of budgets and when to use them, the different approaches to budgeting, and how to use a budget worksheet. Applying good practices when preparing budgets and the tools for managing multiple donor projects. Congratulations! You have reached the end of the module. Please take this time to revisit any of the content we covered today. When you are ready, click the Home button to return to the main menu.